On September 17, 2019, a 44-year-old financial analyst named Marcus was watching his Bloomberg terminal when something strange happened. The overnight lending rate, the rate at which banks loan money to each other for exactly one day, suddenly spiked to 10%. Not 2%, not 3%, 10%. In a market that is supposed to be the most stable, most liquid, most controlled corner of the entire financial system, something had snapped. The Federal Reserve injected $75 billion into the market by morning. The explanation given to the public was technical. The real explanation has never been fully disclosed. That moment, September 17, 2019, was the first sign that the most powerful financial institution in American history was losing control of the mechanism it was built to control. And nobody on the evening news mentioned it. Because the Federal Reserve's greatest tool is not interest rates. It is not quantitative easing. It is not its $8.9 trillion balance sheet. Its greatest tool is the assumption, the deep, unquestioned assumption, that the people running it know exactly what they are doing. Comfort is the enemy of survival. Here is what the Federal Reserve actually is, stripped of the language designed to make you stop asking questions. The Fed is a network of 12 regional banks, technically owned by private member banks, overseen by a board of governors appointed by the president and confirmed by the Senate. It was created in 1913, following a secret meeting on Jekyll Island, Georgia, where the most powerful bankers in America gathered under fake names to design the architecture of a central banking system that Congress had previously rejected twice. The resulting proposal was passed into law 6 days before Christmas, when most of Congress had gone home for the holiday. That is not a conspiracy theory. That is the Senate Banking Committee's own historical record. The Fed's stated mandate is dual: maximum employment and stable prices. Its unstated mandate, the one that has governed every major decision since 2008, is the preservation of financial market stability. And those two mandates are not the same thing. In fact, they are increasingly in conflict. Here is how the mechanism actually works. When the Fed raises interest rates, it makes borrowing more expensive. Mortgages cost more. Business loans cost more. The economy slows. Inflation falls. Eventually, when the Fed cuts rates, the reverse happens. Money gets cheaper. Credit expands. The economy accelerates. Asset prices rise. These are the levers. They are not complicated. What is complicated, what is deliberately obscured, is who benefits when those levers move and who pays. In 2020, the Federal Reserve deployed more money in a shorter period of time than at any point in its 107-year history. Between March and December of 2020, the Fed expanded its balance sheet by $3.2 trillion. It bought treasury bonds. It bought mortgage-backed securities. It bought corporate bonds. For the first time in its history, it hired BlackRock to manage those purchases. The effect was immediate. Financial markets, which had dropped 34% in 33 days, recovered to record highs within 5 months. The S&P 500 posted its best year since 2013. Meanwhile, 22 million Americans lost their jobs. Food bank lines stretched for miles. Eviction moratoriums were the only thing standing between millions of families and homelessness. The market went up. The people went hungry. The Fed announced that its programs had been successful. This is not an accident. It is a structural feature. The Federal Reserve's primary transmission mechanism, the channel through which monetary policy reaches the economy, is the financial system. When the Fed buys bonds, it puts money into the hands of institutions that hold bonds: banks, hedge funds, insurance companies, pension funds, and asset managers. Those institutions then redeploy that capital into financial markets. Stock prices rise, bond prices rise, real estate prices rise. The wealth of people who own those assets increases. And the wealthiest 10% of Americans own 87% of the stock market. When the Fed deployed $3.2 trillion in 2020, it did not write checks to workers. It did not fund small businesses directly. It did not cancel student debt. It bought assets from the institutions that hold assets. The wealth gap, which was already the widest it had been since 1929, expanded by more in 2020 than in any prior decade. Now here is where the Fed's secret playbook reveals itself most clearly. 3 examples, each one exposing the same gap between what the Fed says and what it does. First, inflation. In 2021, the Federal Reserve spent 10 consecutive months calling rising inflation transitory. The word appeared in official statements, press conferences, and congressional testimony. Transitory. By the time the Fed acknowledged inflation was structural and began raising rates in March 2022, the Consumer Price Index was already at 7.9%, the highest level in 40 years. The rapid rate increases that followed drove mortgage rates from 3.1% to 7.8% in less than 18 months, locking an entire generation out of the housing market. The Fed had been behind the curve by its own metrics. The language of transitory had served to delay action that would have imposed costs on financial markets. The costs were ultimately paid by first-time homebuyers instead. Second, the 2019 repo crisis. The event Marcus watched on his terminal in September 2019, the overnight rate spiking to 10%, was caused by a collision of quarterly corporate tax payments and Treasury issuance that drained liquidity from the repo market. The Fed responded by injecting $400 billion between September and February in what it called temporary operations. Critics pointed out this looked structurally identical to quantitative easing. The Fed insisted it was not. 5 months later, COVID arrived, and the distinction became academic. To this day, the underlying fragility of the repo market, the plumbing through which $4 trillion moves every single night, has not been structurally reformed. Third, the Federal Reserve's own financial position. As of 2023, the Federal Reserve is operating at a net loss. After aggressively raising interest rates to fight the inflation it failed to anticipate, the Fed now pays more in interest on reserve balances to member banks than it earns on the bonds it holds. The projected cumulative loss is estimated at $100 billion to $170 billion over the next several years. This loss is simply deferred. It will eventually be subtracted from future remittances to the Treasury, which means the Fed's inflation-fighting campaign, necessary as it may have been, is being partially paid for by the public. This fact has appeared in Fed footnotes. It has not appeared on the evening news. The Federal Reserve is not a conspiracy. It is something more mundane and more dangerous. An institution that has accrued enormous power over 70 years, that is structurally designed to serve the institutions it was created to regulate, and that communicates in a language specifically calibrated to discourage the public from understanding what it is doing. Jerome Powell, the Fed chair as of 2026, is not an economist. He is a lawyer and a private equity veteran who was a partner at the Carlyle Group before joining the Fed's Board of Governors. His predecessor, Janet Yellen, became Treasury Secretary. Her predecessor, Ben Bernanke, works as a senior advisor at a hedge fund. The revolving door between the institution that sets American monetary policy and the private firms that profit from that policy is not a flaw in the system. It is how the system was designed. The question that should keep you awake tonight is not whether the Federal Reserve is competent. It is whether an institution that is technically private, that answers to no elected official in real time, that moves trillions of dollars with no direct public accountability, and that has consistently benefited financial asset holders at the expense of working people, should continue to hold that power unchallenged and unexamined. Because the next time the overnight rate spikes to 10%, and the explanation given is technical, you will know that the technical explanation is not the full one. And the full one will cost someone. It always does. The question is only who.